All right, let's unlock some secrets, shall we? Today, we're diving deep into the world of Warren Buffett and his 12 investment tenets.
Sounds exciting.
It is. And our trusty guide is The Warren Buffett Way by Robert G. Hagstrom. This book, let me tell you, it's like a treasure map.
A treasure map.
Yeah, to understanding how Buffett built that incredible fortune.
I see, I see. And what I find fascinating is how Hagstrom really breaks down Buffett's approach, makes it clear. It's not about magic, it's not about some intuition, it's a framework, a set of principles. And anyone can learn them, anyone can apply them.
Exactly. So that's our mission today, right?
Yeah.
Unpack each of these 12 tenets, see how they work, and most importantly, explore how you, listening right now, can actually use them.
To make smarter investment decisions.
You got it.
I like it. And what makes this so valuable is that it's not just about picking stocks, right? It's bigger than that. It's a philosophy, a way of thinking about business, about risk, about value, long-term value creation.
Okay, so let's dive right in. The book, it breaks these tenets down into 4 categories.
Yeah.
We've got business, management, financial, and market tenets. We'll start with business. And the very first one is all about keeping it simple. Buffett, he famously says he only invests in businesses he can understand.
Makes sense. Don't invest in what you don't get. And this is where that Seize Candies example comes in.
Ah, yes, Seize Candies.
Such a brilliant illustration of this principle. Chocolate. Everyone understands chocolate. Make it delicious. Sell it at a premium. Enjoy consistent profits. Simple.
Very cool, and it leads perfectly into tenet number 2, wouldn't you say? Consistent operating history. Now, they haven't just been around for a while, they've been consistently profitable.
Yeah.
Why is that consistency so important?
It's about risk, right? You reduce risk. A company with a track record, steady performance, like Seize Candies, it shows they can navigate the market. The fluctuations, economic downturns, changing tastes. That consistency gives confidence. Confidence in future earnings.
So you're not just betting on a good idea, you're betting on a proven track record.
Exactly.
And that brings us to the third business tenet, favorable long-term prospects. It's not enough to do well today. You need an advantage, a sustainable advantage for the future.
Absolutely. Buffett, he isn't looking for a quick win. He wants companies with a moat. Those unique qualities, the things that protect them from competition and allow them to, well, just generate profits for years to come. Think Coca-Cola, one of his most famous investments.
Ah, Coca-Cola. I was waiting for that one. Global brand, loyal customers, distribution network, practically unbeatable. You're talking about a moat.
Exactly. And that's what attracted Buffett. Staying power, a brand that would last, a product people want worldwide.
It makes you thirsty just thinking about it. But even with a fantastic business, a wide moat, you need the right people at the helm. Which brings it to the management tenets. And Buffett, he always starts by asking, is management rational?
Ah, the people in charge. He wants to see leaders that make smart decisions, logical decisions, especially
Yeah.
when it comes to, well, money, allocating capital. Are they investing wisely? Are they returning excess cash to shareholders? Or are they wasting it all on vanity projects or bad acquisitions?
It's your money they're playing with, so you better make sure they're responsible. And speaking of responsibility, that leads right into tenet number 5. Is management candid with shareholders?
Transparency, that's what Buffett values. Leaders who are honest, upfront about the good and the bad, the challenges, the opportunities. They don't try to hide things. They communicate clearly, openly with the people who trust them with their capital.
It's all about building trust, isn't it? You're a partner in the business. You need to know that management's on the level.
And Buffett himself, he's a perfect example. His letters, his annual letters to Berkshire Hathaway shareholders, they're legendary. Candor, wit, insight. He doesn't shy away from discussing mistakes. He shares what he's learned.
That's refreshing. Okay, but sometimes, even the best managers, they can get caught up in what everyone else is doing. It's like a herd mentality. And that's what Buffett's 6th management tenet is all about. Resisting the institutional imperative.
Yes. You could say, do they have the guts to go against the grain? To not just follow the trends, the peer pressure. Buffett looks for independent thinkers. Leaders who will make decisions maybe unpopular in the short term, but in the end are the best for the long term.
So it's not about being contrary for the sake of it. It's about doing what's right, even when everyone else is going the other way.
Exactly. And a great example is Geico, a company Buffett has admired, invested in for decades. While other insurers were, diversifying, getting into things they shouldn't, often with disastrous results, Geico stayed focused, laser focused on low-cost auto insurance.
Smart. And that focus, that discipline, it allowed them to become a dominant force in their niche.
They didn't get distracted by shiny objects. They stuck to their strengths.
Which is a powerful lesson for any business, really. But enough about that. Let's talk numbers. Those financial tenets. The ones Buffett uses to really assess a company's earning power.
Now we're getting to the heart of it. This is where we go from, talking about qualities to the quantitative. Buffett, he's a master at dissecting financial statements, and he's got these key metrics, these tools that help him find undervalued businesses with, solid foundations.
He starts by saying,
focus on return on equity, not earnings per share.
Return on equity. Okay, so break that down for us. Why is return on equity, or ROE, so important?
It tells you how effective a company is, how effective they are at using, shareholder money to make a profit. It's about efficiency, profitability. It goes beyond just looking at net income. You see, earnings per share, that can be manipulated through accounting tricks or, buybacks to inflate the number. ROE, it cuts through all that. Shows you the real return. The return a company is generating on the capital invested by, its shareholders. It's like, evaluating a fund manager. You want to see how much profit they're generating with each dollar you've given them.
Makes sense. So efficiency and profitability, not just the overall amount of money they're making.
You got it.
And I remember from the book, Buffett uses Wells Fargo as an example of a company with a consistently high ROE, demonstrating that smart use of shareholder capital.
Yeah, precisely. Wells Fargo, under Buffett's watchful eye for many years, has consistently delivered a high ROE, which tells us they're able to generate those strong profits from the equity invested in their business. But ROE, it's just one piece of the puzzle. Buffett, he goes even deeper. He emphasizes something called owner earnings.
Okay, now this is where it gets interesting. Owner earnings. What are those? And why are they so important to Buffett?
Owner earnings, think of it as the true cash flow, the cash flow a business generates. It goes beyond that net income figure, the one you see on the income statement, which can be, manipulated. It factors in things like capital expenditures, the money a company needs to reinvest, to keep things running, to fuel future growth.
So it's about understanding how much cash the company is actually generating, not just what's on paper.
Exactly, like looking under the hood of a car, not just admiring the shiny paint. And Buffett, he uses this metric to assess companies like Coca-Cola, making sure they're not just showing profits on paper, but actually churning out real cash that can be reinvested, returned to shareholders, or used to strengthen their position, against competitors.
Or it's about sustainability.
Yeah.
Right. Making sure they've got the fuel to keep growing, thriving over the long haul.
You got it. And another key financial tenet that Buffett emphasizes, he says, look for high profit margins.
High profit margins.
Might seem obvious, but it's surprising, how many investors overlook this fundamental principle.
So why are high profit margins so crucial? I mean, it seems pretty straightforward, but I'm sure there's more to it.
There is. High profit margins, they tell you about a company's ability to control costs, to price their products well, and ultimately to generate more profit from each dollar of sales. Think of it like this. Companies with those high margins, they've got a cushion to absorb unexpected expenses, to invest in growth, to weather the storms, the economic storms. They're just, more resilient.
A financial safety net.
Exactly. And I remember See's Candies, with their premium chocolates, their efficient operations, they have those exceptional profit margins, the kind that contributes to that long-term success.
See's Candies again?
They're a classic example. They understand the power of high profit margins. They don't just sell chocolates, they sell an experience. And they get a premium price while still keeping those costs under control. That's the recipe, right, for long-term profitability.
It's not just about revenue, it's about how much that revenue actually becomes profit.
You got it.
And finally, we have the $1 premise, which, it sounds intriguing.
It does, doesn't it?
Tell me more about this one.
The $1 premise. It gets to the core of how Buffett thinks. About retained earnings. Those are the profits a company keeps, instead of giving them out as dividends. He believes every dollar they keep, every dollar retained, should create at least $1 of market value.
So it's not just about holding on to the cash. It's about making sure that cash is working hard for the shareholders.
Oh, got it too. Buffett doesn't want companies to just hoard cash. He wants them to reinvest it wisely in projects that will generate future growth, increase the intrinsic value of the business. And he's done this brilliantly with, well, Berkshire Hathaway itself, using those retained earnings to acquire promising businesses, to expand into new markets, and to build a diverse, profitable portfolio of assets.
It's like being a responsible steward of
Right.
capital, whether you're running a company or making your own investment decisions. So we've covered a lot: the business tenets, the importance of a solid management team, and now those key financial metrics, the ones Buffett uses to assess a company's true worth. But we're not done yet. There's still more to uncover.
Oh, there's more.
We still need to talk about those market tenets, the ones that guide his buying decisions. After all, it's not enough to find a great business, right?
Right.
You need to buy it at the right price.
Absolutely. And that's where the final two tenets come in. Determining the intrinsic value of a business and then buying it. Buying it at a price that offers a margin of safety, which is very important.
Okay, let's break it down then.
Yeah.
How does Buffett actually determine the intrinsic value of a company? I mean, there's no price tag, right? Not that simple.
It's more of an art than a science, I'd say.
Yeah.
But Buffett, he has a system, a systematic approach. He starts by considering all those factors we've talked about: the quality of the business, the strength of the management, their financial performance, and of course, their long-term prospects. Then he uses something called a discounted cash flow analysis. He projects the future cash flows and then discounts them back to present value.
So he's not just looking at the current earnings, he's trying to estimate what the company will be worth in the future, factoring in all those things that can influence its growth, its profitability.
Precisely. And he doesn't rely on, complex models or anything like that. He focuses on understanding the core drivers of the business, making reasonable assumptions, and applying a conservative discount rate to account for risk and for uncertainty.
It's about focusing on the fundamentals, developing a realistic assessment, what the business is truly worth.
You got it. And once he's determined that intrinsic value, he waits patiently for the market to offer him a price that's significantly lower. This is where that famous margin of safety comes in.
The margin of safety. Now, that's a concept I love. It's like having a buffer, a cushion,
Yeah.
protecting yourself from, well, the unexpected or from errors in judgment.
Exactly. Buffett doesn't just buy when it's slightly undervalued. He wants a bargain, a price that's so attractive that it makes up for the risk he's taking.
So it's not just about finding a great business. It's about finding it at a great price. The opportunity to, buy $1 for 50 cents.
That's it. And Buffett has shown this time and time again, making these bold investments in companies like American Express during a crisis. When everyone else was panicking, the market was undervaluing their potential, their long-term potential.
That's why they call him the Oracle of Omaha.
Right.
Seeing value where others see fear.
Exactly. And that ability, it comes from his deep understanding, his disciplined approach to valuation, and his commitment, his unwavering commitment to buying only when the price is right, only when it makes sense.
So we've covered all 12 tenets, the business stuff, the management, the financial metrics, and those market principles, like, I don't know, a whole philosophy, one that's led to extraordinary success. But how does it all come together? In the real world, how can someone actually apply these principles to their own, investment journey?
That's the big question. And that's what we're going to explore in the final part of our deep dive. We're going to take everything we've learned and see how it can be used to make smarter decisions, more informed investment decisions.
All right, welcome back to the show. We've been on quite a journey, haven't we, digging into those 12 investment tenets, from the ins and outs of understanding a business to, really scrutinizing the management and, of course, those financials. A lot to cover.
It is a comprehensive framework. But as we wrap up this deep dive, the question is, how can someone actually use these tenets in their own investment journey?
You're right. It's great to understand the theory, but putting it into practice, well, that's the real test. So walk us through it. How can we, the listeners, use these tenets to become, better investors?
Okay, imagine this. You're researching a company, a potential investment. Let's say it's, I don't know, a plant-based meat company, a hot sector these days.
Plant-based meat. Interesting. Sustainable, trendy. Where do we start? Which tenet comes into play first?
Well, remember Buffett's first principle. Keep it simple. Can you understand their business model? Do they make a product you get? Operate in a market that makes sense. If it's too complex, too hard to grasp, well, that might be a warning sign.
Right. Sometimes the best opportunities are the ones you can easily understand. No need to overthink it. So let's say this company, they pass the simple and understandable test. What's next?
We look at their history, their operating history. Yeah. Are they brand new? A startup with no track record? Or have they been around for a while? Have they shown steady growth? Consistent profitability?
Consistency. That's key. We're looking for evidence that they can navigate those market ups and downs, manage their operations well, deliver those profits year after year.
Exactly. Past performance isn't everything, but it tells you something. It shows you whether a company can execute their plan,
Yeah.
and generate those sustainable earnings.
So let's say our plant-based meat company has been around for a few years. Good growth, solid financials.
Yeah.
What about the future, those long-term prospects? How do we assess that?
We look at the competition, the competitive landscape. Do they have a strong brand? Proprietary technology? Loyal customers? A cost advantage? These are signs of a moat, remember, that durable competitive advantage that Buffett loves.
It's about what sets them apart, right?
Okay.
What makes them uniquely positioned to win in the long run. So maybe this plant-based meat company, they've developed some incredible new protein. Tastes amazing.
Right.
Better than anything else out there. Or maybe they've built a brand that really resonates with, health-conscious consumers.
Exactly. Those are all good signs. Signs that point to those favorable long-term prospects. But even the best business, it needs the right people running it. So now we look at the management. Those management tenets. Are they rational? Making smart choices with the money, investing for growth, but also keeping those shareholder returns in mind.
We're looking for disciplined capital allocation, sound financial management, a clear vision for where they're going.
Exactly. And they need to be thinking long-term,
Hmm.
like owners, making those decisions that benefit the business and, of course, the shareholders. And speaking of shareholders, how's the communication? Are they candid about the challenges, the opportunities? Do they communicate clearly and honestly with those investors?
Honesty and transparency, that's so important. You want to see that management is being upfront, not trying to hide anything.
And most importantly, their actions need to match their words. Do they actually walk the talk? Are they delivering on those promises?
And finally, can they resist the institutional imperative? Can they go against the grain, make those tough decisions that might not be popular right now, but are the best for the long term?
It's about being independent, willing to chart their own course, even when everyone else is doing something different.
So this plant-based meat company, they need to stand firm in their beliefs. Even if, everyone else is pressuring them to follow some trend or chase those short-term profits at the expense of the long term.
Right. Now we get into the numbers, those financial tenets. First, the return on equity.
Hmm?
What's the ROE telling us about their efficiency, their profitability? Are they generating those good returns on the capital that shareholders have invested?
We're not just looking at the earnings per share. That could be, misleading. We want to see that they're using that shareholder capital effectively to create those sustainable profits.
Absolutely. ROE, it paints a clearer picture. And then we look at owner earnings, remember, the true cash flow, taking into account those necessary capital expenditures.
We want to see that our company, they're generating enough cash to keep things running, to invest in their growth and maybe even return some of that cash to those shareholders. Dividends, buybacks, that sort of thing.
And don't forget the profit margins. Are they healthy, sustainable? Can they maintain those margins even when, competition increases or costs go up?
High profit margins, that's a good sign. It shows pricing power, efficiency, and the ability to handle those market pressures, a key indicator of that long-term profitability.
Exactly. And then we have the $1 premise. Are they reinvesting those retained earnings wisely, creating at least $1 of market value for every dollar they keep?
Making sure those profits are fueling future growth, not just, sitting idle or being used for pointless acquisitions.
Right. Now we're at the final two tenets, the market tenets, the ones that bring it all together. First, we need to figure out the intrinsic value. And we've got all the information we need, right? We understand the business, we've looked at management, analyzed those financials, and considered the long-term picture.
So it's about putting the pieces together, using our tools like discounted cash flow analysis to come up with an estimate, a reasonable estimate of what the company is really worth.
Exactly. And remember, this isn't a perfect science. There's always some judgment involved. But by being thorough and, conservative in our assumptions, we can get a range of values, a sense of what that business is worth.
And once we have that intrinsic value, we wait, patiently wait for the market to give us a price that's right, a price that gives us that margin of safety.
You got it. We don't want to overpay, even for a fantastic business. We want that bargain, that price that makes up for the risk and allows us to, achieve those great returns over the long haul.
So it's a combination, finding that great business and then being patient, waiting for the right moment to buy at a price that makes sense.
You got it. And by applying these 12 tenets, you dramatically increase your chances of investment success.
This has been a fascinating deep dive. We went from understanding those tenets, those core principles, to seeing them in action,
Yeah.
like a roadmap for the investment world.
And these tenets aren't just for the pros, Anyone can use them
Hmm?
to make smarter financial decisions.
It's about thinking like an owner, right? Being patient, disciplined, and focusing on that long-term value.
Absolutely. So on that note, we'll wrap up our exploration of Warren Buffett's 12 investment tenets. Pick up that book, The Warren Buffett Way, and dive deeper into those principles.
It's a book that can really change your perspective, help you build a better financial future.
Until next time, keep learning, keep exploring, and keep diving deep.